The basic accounting equation is a fundamental concept in accounting. It represents the foundation of the balance sheet. The equation states that assets are equal to liabilities plus equity. Assets represent what a company owns. Liabilities represent what a company owes to others. Equity represents the owner's stake in the company. This simple equation showcases the balance between a company's resources and how they are financed. This equation must always hold true. This is because every transaction a company makes will impact both sides of the equation. For example, if a company takes out a loan, its assets, like cash, will increase. At the same time, its liabilities, such as loan payable, will also increase by the same amount. This ensures that the equation remains balanced. Understanding the basic accounting equation is crucial for comprehending the financial health of a business. It provides a snapshot of a company's financial position at a specific point in time. By analyzing the components of the equation, stakeholders can gain insights into a company's liquidity, solvency, and overall financial stability. This understanding is essential for making informed financial decisions. In conclusion, the basic accounting equation, assets equal liabilities plus equity, is the cornerstone of accounting. It represents the relationship between a company's resources, obligations, and the owner's stake. This equation must always remain balanced, ensuring that every transaction is accounted for accurately. Understanding this fundamental concept is vital for anyone involved in business or finance. To further delve into the world of accounting, we expand upon the basic accounting equation. This expanded version provides a more comprehensive view of a company's financial performance. It incorporates elements like revenues, expenses, and dividends. These elements reflect the operating activities of a business. They show how a company generates profits and distributes them to its owners. The expanded accounting equation is represented as follows: assets equal liabilities plus equity plus revenues minus expenses minus dividends. Revenues represent the income generated from a company's primary business activities. Expenses, on the other hand, are the costs incurred in the process of generating those revenues. Dividends are the portion of profits distributed to the company's shareholders. By incorporating these elements, the expanded equation provides a more dynamic picture of a company's financial performance over a period of time. It shows how the company's operations impact its assets, liabilities, and equity. For instance, an increase in revenues leads to an increase in assets, like cash or accounts receivable, or a decrease in liabilities, such as deferred revenue. Conversely, expenses reduce assets or increase liabilities. Understanding the expanded accounting equation is essential for analyzing a company's profitability and overall financial health. It allows stakeholders to assess the effectiveness of a company's operations and its ability to generate profits. By examining the relationships between revenues, expenses, and dividends, investors and creditors can make informed decisions about their investments and lending activities. In conclusion, the expanded accounting equation offers a more comprehensive understanding of a company's financial picture. It incorporates revenues, expenses, and dividends, providing insights into a company's operating activities and their impact on its financial position. This expanded view is critical for making sound financial decisions and evaluating a company's long-term sustainability. Dr. Soewarsono's tax accounting equation, or TAE, is derived from the expanded accounting equation. It focuses on the relationship between a company's revenues, expenses, assets, and liabilities. This equation is particularly relevant for tax purposes, as it highlights the elements that are considered taxable income. The TAE is represented as follows: revenues minus expenses equal assets minus liabilities. This equation is derived by rearranging the expanded accounting equation, assuming that equity and dividends are both zero. This simplification allows us to focus on the core components that impact a company's tax liability. The TAE has significant implications for forensic accounting. By rearranging the equation, we arrive at the following expression: expenses plus assets equal a constant. This implies that the sum of a company's expenses and assets should remain relatively stable over time, barring any significant changes in business operations or investments. Any substantial deviation from this relationship could indicate potential anomalies or irregularities in a company's financial reporting. Forensic accountants can use the TAE as a tool to identify red flags and investigate potential financial statement fraud. For instance, a sudden spike in expenses without a corresponding increase in assets could raise concerns about potential embezzlement or misappropriation of funds. In conclusion, Dr. Soewarsono's tax accounting equation provides a valuable framework for understanding the relationship between a company's revenues, expenses, assets, and liabilities. By simplifying the expanded accounting equation, the TAE focuses on the key elements that impact a company's tax liability. Moreover, the equation's implications for forensic accounting make it a powerful tool for identifying potential financial irregularities and ensuring the accuracy and integrity of financial reporting. Building upon the implications of Dr. Soewarsono's tax accounting equation, we can further explore its application in forensic analysis. The equation's rearranged form, expenses plus assets equal a constant, provides a powerful lens through which to scrutinize a company's financial activities. This equation suggests that any significant increase in expenses should ideally be accompanied by a corresponding increase in assets. For instance, if a company invests heavily in new equipment or expands its operations, we would expect to see a rise in both expenses and assets. This correlation indicates that the company is utilizing its resources effectively to generate future revenue. However, if expenses increase substantially without a corresponding increase in assets, it could indicate potential financial irregularities. This disparity might suggest that the company is inflating its expenses, perhaps to reduce its tax liability or conceal fraudulent activities. Forensic accountants can utilize the TAE to identify such discrepancies and investigate the underlying reasons for the unusual financial activity. Furthermore, the TAE can be used to assess the validity of a company's revenue recognition practices. By analyzing the relationship between revenues and liabilities, forensic accountants can identify potential revenue manipulation schemes. For example, if a company reports a significant increase in revenues without a corresponding increase in liabilities or a decrease in assets, it could indicate that the company is recognizing revenue prematurely or improperly. In conclusion, Dr. Soewarsono's tax accounting equation is not merely an accounting tool, but a powerful instrument for forensic analysis. By understanding the relationship between expenses, assets, revenues, and liabilities, forensic accountants can identify red flags, investigate potential fraud, and ensure the accuracy and transparency of financial reporting. The TAE serves as a cornerstone for maintaining financial integrity and upholding ethical business practices.